If invested right, you can double this $1,000 in 7 years. What's up guys, I'm Rose, and if you've never invested before and you want a super beginner-friendly video to break down some of your investing options, then this video was made for you. I'm gonna show you 10 ways to invest $1,000, and I'll walk you through each tip step by step so that you'll actually be able to start putting your money to work after watching this video. The first way you can invest your $1,000 is to invest it in an index fund. An index is a tool that quickly tells you how the stock market is doing. There are lots of indexes out there, like the Dow, NASDAQ, and a bunch of others, but let's use the S&P 500 as an example because it's the most widely used stock market index. The S&P 500 is a sample set of the 500 largest companies, all rolled up into one easy-to-read average price. So if you wanted to know how the US stock market performed in 2018, rather than looking up all 500 stocks individually, you can just look up where the S&P 500 started the year and ended the year, and that would tell you how the stock market did in 2018. Although there's a lot more than 500 stocks in the United States, there's actually 3,671. The S&P 500 is a pretty accurate barometer of how the overall US stock market is doing because it has the 500 largest US stocks. So back to index funds. An index fund is an investment vehicle that mirrors an index. Remember, the S&P 500 index, it's just a calculated average of 500 different stock prices, so you can't invest in the S&P 500, it's just a number. But you can invest in an S&P 500 index fund. When you invest in an S&P 500 index fund, you immediately become a part owner in each of the 500 companies in that index. And if the S&P 500 index goes up 5%, your investment in the index fund also goes up 5%. If the S&P 500 goes down 5%, your investment also goes down 5%. There's two really good reasons to invest in an index fund. The first reason is that you get safety in numbers. With an index fund, you don't have to know how to pick stocks because the S&P 500 consists of 500 widely diversified stocks across different industries, sectors, and you don't have to be a genius to benefit from the wealth-creating capabilities of the stock market. All you have to do to get on that long-term upward trend is to invest in an index fund. So if you're not interested in researching individual stocks, then you have to rely on safety and numbers. This strategy is also known as diversification. And it works because although not all stocks go up over the long term, the overall market does go up over the long term. The second reason is that index funds offer automatic reinvestment. This is really convenient. Once you make your initial $1,000 investment, you'll probably want to keep adding to your nest egg. So what you can do is set up automatic monthly contributions from your bank account, and the index fund will reinvest this additional cash back into the fund every single month at no additional cost. So you can literally just set it and forget it, because everything is done for you. There's a few good S&P 500 index funds out there, and it doesn't really matter which one you get. They all track the S&P 500 very closely, and they're all very low cost. So here are two you can Google to jumpstart your research: SWPPX and FXAIX. The second way to invest your $1,000 is to invest in an ETF. ETF stands for Exchange Traded Funds, and they're very similar to index funds. Just like index funds, ETFs track an index, and the only difference is in how they're traded. For example, SPY is an S&P 500 ETF that is the exact equivalent of the FXAIX, an S&P 500 index fund, the one that I just mentioned, and both of them are pooled investment vehicles that give you easy access to a large selection of stocks. So you get access to hundreds and thousands of different stocks, all with one easy purchase. But with the index fund, you can only buy and sell your shares once a day, and with the ETF, you can buy and sell anytime the stock market is open because it trades just like a stock. Some people prefer ETFs because they like being able to buy and sell their shares whenever they want. But however, a big downside to ETFs is that they don't offer automatic reinvestment. So if you want to keep adding to your portfolio every month with an ETF, you'd have to buy more shares of that ETF every month with that additional money. Otherwise, your cash will just sit there, and that will probably incur more trading commissions and fees. So if you just want something to set it and forget it, and it'll just automatically get reinvested every month, then you should just go with index funds. The third way to invest your $1,000 is to invest using a Roboadvisor app. Now, there's a lot of these new apps out there, and they make it super convenient for you to invest. Some of them are like Stash, Betterment, Acorns, Ellevest, Wealthfront, and the best part is none of them really have any investment minimums. So with $1,000, you're definitely good to go. These apps make it super easy. You hook up your bank account, transfer over some money, and boom, your money gets invested in one of their cookie cutter portfolios that are professionally designed. Out of all the apps, I love Acorns. It has a really cute, easy to use user interface, and it has this feature where you can link up your credit card or debit card, and it'll round up every purchase you make and invest that spare change into your portfolio. So if you really have a hard time saving any money, then this could be a good way to just get started. All these apps essentially do the same thing. They'll just ask you some basic questions about your age, your financial goals, and your time horizon. And then based on your answers, they create an investor profile for you. and they'll put your money into a pre-packaged portfolio tailored to your investor profile. These pre-packaged portfolios combine a handful of ETFs that will give you well-rounded exposure to a variety of stocks and bonds. It's important to note that Acorns gives you, and other apps like Acorns, give you very little control over your portfolio. So you only get to choose between their pre-packaged portfolios, and you can't just buy whatever individual stock you want. So it's the same with all the apps. You're basically giving up control in exchange for convenience and simplicity. So if you want to put your money to work and not have to think about it too much, and you really don't want to take the time to learn to do it on your own, then definitely consider investing with one of these apps. The fourth way to invest is to invest in stocks using the magic formula. Now, if you're more of the DIY type, you might prefer investing in individual stocks. And you probably know this, but the stock market right now is at all-time highs, and it's been making record highs and has been on the longest bull run in history. So that makes people nervous because nobody wants to be that person who buys in at the very top and then everything crashes. So at this point in the cycle, you want to be really careful, and it's hard to find good bargains out there. So what's a girl to do? Luckily, there's a solution, and it's called Magic Formula Investing. Based on two simple financial metrics, earnings yield and return on capital, the Magic Formula filters through the thousands of companies you could invest in, and it shows you only the stocks that are priced cheaply relative to their earnings potential. The idea is that if you're buying good companies for cheap, then your risk is super low because there isn't much room for the stock price to go any lower. So the Magic Formula is a really handy stock screener so that you only get the good deals and not the really expensive ones that are the first to crash. If you want to learn more about this strategy, then check out this little book, the little book that still beats the market. It's only like 150 pages long, and it's written by a really smart fund manager named Joel Greenblatt. He explains the whole strategy step by step, and it's all written in plain English. I read it in one day, and I highly recommend it. The fifth thing you can do with your money is to invest it in the money market. Maybe you're not ready to invest in the stock market yet. Maybe you just want to park your cash somewhere until you decide what you want to do with it. Then consider putting it into what is called a money market fund. The money market is a place to park your cash short term and earn a decent yield of about 2 to 3%. When you invest in the money market, you're lending your cash to short-term borrowers, meaning loans with maturities around 3 to 6 months. And it's a very safe place to keep cash because there's hardly any interest rate risk and generally very little credit risk. So I don't know about you, but earning 2 to 3% on my money is way better than my savings account, which I don't know of any savings account that pays very much. They're pretty much close to zero. The money market is where huge companies like Apple and Berkshire Hathaway and a bunch of individual investors like you and me invest their extra cash when they have extra cash reserves. And while 3% isn't much, it at least helps your cash keep up with inflation. So if you ever need the cash, you can just get your cash out of your money market fund the next day. But meanwhile, the money isn't just sitting there doing nothing. So it's a really good option. Although there's different ways to invest in the money market, I think money market funds are the best way for individuals to access it because they're low cost and diversified, so that will maximize your return while reducing your credit risk. Some popular low-cost money market funds that you can look into to jumpstart your research are FDLXX and VMFXX. These are both big funds that invest in a mix of US government securities. The sixth thing you can do is to invest in building up your emergency fund. I know this is really boring personal finance advice, but it's actually really important for investing. Having an emergency fund gives you a cushion so that you're never forced to sell your investments just to pay for an unforeseen expense. You need to have this cash cushion because you never know what the market's going to do, and the last thing you want is to have to sell them at the worst possible time after a dip in the market just to come up with some cash. Because if you do have to sell your investments during a downturn just to come up with cash, then you won't be invested in the market anymore when it recovers. So you'll just lose and lock in those losses. So since investing success is all about the long term and staying in it for the long term, you never want to tie up cash that you need for short-term stuff in the stock market, because the stock market is a long-term place. It's not a short-term place. So a good rule of thumb is to have about 3 months worth of expenses in your emergency fund. But I know that's a lot, so $1,000, even just $1,000 makes a great starter emergency fund. And then you can always add a little bit to it every month until you have enough to cover you no matter what happens. Number 7, another way to invest your $1,000 is to try out one of those real estate crowdfunding platforms. Traditionally, real estate requires a good amount of capital, but thanks to crowdfunding technology, now you can invest in real estate with just $1,000 or even less. Fundrise is a platform that crowdsources funds online from small investors, and it uses that money to buy investment property all over the US. What I like about Fundrise and real estate investments in general is that they offer a balance of dividends and growth. Real estate generates steady income from rents, but it also appreciates in value. And since I'm young, I definitely want growth, and the dividends are just a bonus because I can either reinvest them right back into the fund or spend it on other things. The minimum investment at Fundrise is only $500, and the whole onboarding process is super easy. Before you make an investment, you can see the photos and addresses of the projects that your money will be invested in. You can review the financials, and you can even drive by to look at the properties, and you can check it out in person. Tip number 8. Another way to invest your $1,000 is to invest it in a REIT, or a real estate investment trust. This is another way to invest in real estate, similar to crowdfunding, but it's actually, a REIT is a stock. It's a stock in a company that owns income-producing real estate. REITs trade on an exchange, just like stocks. So they trade on the same exchange as where Apple and Microsoft and all these big companies that you know about trade, but it's ownership in a company that owns real estate. And it's a good way to start dipping your toes into real estate because it's obviously a lot cheaper to buy one share of a REIT than it is to buy an entire property. And because of their focus on income-producing properties, they're pretty good for people who are looking for dividends, but also want a little bit of growth as well. Let's have a look at SPG, or Simon Property Group. This is a well-known REIT that owns commercial properties all over the United States, and their dividend yield right now is about 4.5%. That means on a $1,000 investment, you'll get a dividend check for $45 every year. The biggest difference between REITs and crowdfunding platforms like Fundrise is the transparency and the type of properties owned. Since REITs are publicly traded companies, they have much stricter requirements for financial reporting. Also, REITs are required to focus on income-producing properties, whereas Fundrise deals are allowed to be a little more speculative and growth-focused. Number 9, you can invest in paying down debt. Okay, I know this isn't really an investment in the traditional sense, but when you get rid of debt, those monthly payments can go towards building up your investments instead of going towards debt. I used to have six-figure student debt, and my monthly payments were almost $1,000. So before I got serious about getting out of debt, I literally had zero investments, zero money to put towards investments. But now that most of it's paid off, I have an extra like $800 every month to save and invest, and that's when my investment portfolio really took off. On a standard student loan at 6% interest, reducing your principal by $1,000 frees up $10 of extra cash flow a month. You can then automate a $10 transfer into your investment account every month, and boom, you're on your way to building up some really good investment habits and to building up your nest egg. So if debt is preventing you from being able to consistently put away money towards your savings and investments, then the best way to invest your $1,000 might be to start paying down your debt. Last but not least, the ultimate investment is investing in yourself. Einstein once said, "We can't solve problems by using the same kind of thinking we used when we created them." In other words, the person who has $1 million in the bank is not the same person as the one who has $100 in the bank. So to go from A to B, you literally need to become a different person and think differently. I've invested tens of thousands of dollars in personal development programs, meditation retreats, workshops, online courses, coaches, you name it. And it's so worth it. If I hadn't done that, I probably never would have gone out of debt or even started taking action on any of my investing goals. When you invest in yourself, then you upgrade your mental software so that you can think differently, think bigger, and break through any of the invisible and subconscious barriers that you have in your life right now. I'll link below to some of the programs that have made a big difference in my life, so you can check them out if you're interested. If you liked this video, hit that subscribe button below and share this video with your friends so we can open up the conversation around money and build a sisterhood of financially savvy, empowered women. Always remember to go after your dreams unapologetically and to live life on your terms. Not anyone else's, your terms. Cheers.